Welcome everybody to the Pan-African Resources webinar today. Speaking from the company, we have Cobus Loots, Executive Director and CEO, Dion Lowe, Finance Director, and Hethan Hira, Head of IR. I invite everybody to wait till the end to ask questions. The presentation will last around 30 minutes, and at the end you'll be able to raise your hand or type your questions into the Q&A. Now that all the attendees have joined the meeting, Pan-African, I'll hand over to you to start the presentation. Thank you.
Thank you very much, and thank you for joining us this morning. So if we move to slide 2, that's the normal disclaimer and forward-looking statements, and then swiftly on to slide number 3, which is just a recent accolade we received as Pan-African Resources PLC. In terms of all of the companies listed on the Johannesburg Stock Exchange, we achieved a number 9 position. That's in terms of overall returns to shareholders over 5 years. Clearly, I mean, we were assisted by the current buoyant gold price, but we also believe it's a product of us focusing on sustainable profits, focusing on capital allocation, and sensible growth. So yeah, we look forward to in the next slides emphasizing all of those points. If we move on to slide number 4, just a brief overview of the presentation. So we'll start with the corporate overview and highlights, and then just spend a bit of time on the board. We'll speak on South Africa and the operating environment in South Africa, as all of our assets currently are based in South Africa. The impact of COVID-19 on our operations we can address. ESG is critical to us, and happy to give some more background to our ESG initiatives, and then speak about our operational performance and our assets, and also our organic growth projects. Can conclude with our objectives for the financial year FY 2021. So our year end is June 2021. So we're actually quite well advanced into the next financial year already. On slide number 5, a corporate overview. Pan-African Resources PLC. So we're a UK company. Management is based in Johannesburg, South Africa. In terms of the register, about 60% of the register is held in South Africa by mostly blue chip investment institutions, the likes of Allan Gray and Investec 91. 40% of the shares are held in the UK and Europe, and we've actually built a very good base of support in that market also. So those include shareholders such as the dedicated gold fund Rafa. Our market capitalization is about $650 to $700 million at this point. And later in the presentation, we can also speak about our net debt position and our very rapid de-gearing that we're currently seeing on the balance sheet. Clearly, I mean, we also now have launched an ADR program in the United States. Pretty much all of our South African peers have some level of US presence, and we believe that we have quite a lot to offer the US market also. And again, that'll sort of become clear in the next slides. Very briefly on slide number 6, the board, myself, I've been with the company since 2009, initially as finance director, and then as non-executive, and finally for the last 5 years as CEO. Dion, our financial director, has been in the company also for more than 5 years. Our chairman, Keith Spencer, he's a well-known South African and African gold miner. He started his career with Gold Fields in South Africa and sort of specialized in gold, copper, and many other commodities. And the rest of the board is well diversified and well experienced. I think on slide number 8, just spending a couple of minutes on the operating environment in South Africa. And oftentimes when we speak to international audiences, we get quite a bit of negativity around South Africa. Principally, the questions revolve around the empowerment legislation, around the stability of power supply, security, and sort of also the labor situation. So, South Africa certainly has challenges in terms of operations, but sort of having been involved in operations elsewhere in Africa, also, it's a challenging continent to do business. And hence one has to equip yourself and really skill yourself to be able to operate successfully. So, Pan-African has operated for many years successfully in South Africa. As a matter of fact, our flagship gold mine, Barberton Mines, started operations in 1886. So it's been operating uninterrupted in South Africa for more than 130 years. That's, in my mind, quite a good track record. Also, South Africa has a number of other positives. From a mining legacy perspective, we have more than 100 years of gold mining, of deep level and large scale gold mining experience. So I think about 50% of all of the world's gold has come from our mines. We still have all the technical expertise. We well supported technically. If we have a breakdown or we need to source equipment, we can do so within a matter of hours. Our electricity grid is still the second largest, I believe, in Africa. And as a company and a business, we haven't experienced major blackouts or interruptions. And we'll speak a little bit in the next slides also about some of our initiatives on solar power that certainly is going to further reduce the costs of our operations. But yes, I mean, we were able to manage the electricity situation. And also, it does appear in recent months as though the local electricity utility is getting its act together, and there's some positive developments on that front. Mining tenure, we have clear rules and regulations, and we're compliant with all of those. That's also a positive. And then again, I've spoke about ESG. So the social side of our business is critical to us, and we're sort of very happy to. In some of the late slides, report on the initiatives in that regard. COVID-19 and the impact. On slide number 10, it's a question we get asked. So fortunately in South Africa, we're not yet seeing a major second wave in the mining industry. As a matter of fact, the numbers are right down. Our South African mining industry is very used to dealing with communicable or infectious diseases, including TB, HIV and others. So, I mean, we've really utilized all of these protocols and procedures to also gear ourselves up for dealing with COVID. We did have a lockdown in South Africa, but government experienced or certainly knows or understands the importance of the mining industry. So we were allowed to operate, although albeit at a reduced capacity for some time, but we're fully back to steady state and full scale operations. And as a matter of fact, we managed to actually do quite a bit better than our revised guidance for the previous financial year. So that really demonstrates the commitment of our people and the level of focus that we applied. And also, we source about 50% of our gold from surface remining or tailings remining that we'll talk about in some of the next slides. So we managed to operate these businesses with probably about 20 to 30% of our workforce at very close to full capacity for a limited time. So that also assisted us. I mean, through all of this, we also supported local communities around our mines and operations and the most vulnerable. So we supplied foodstuffs and other essential items, and we actually continue to support many of the communities around our operations. And certainly in terms of health and safety, our protocols as far as COVID is concerned are still very much in place. If we move on to ESG, and just a quote, so that we committed to producing high margin ounces in a safe and efficient manner whilst investing in local communities and minimizing the environmental impact of our operations. So again, I mean, we don't operate large scale open pit operations. Our operations are mostly either underground, where the impact on surface is very limited, or are actually in themselves rehabilitation efforts, and that's really the tailings remining that we're doing that we'll speak about. So 50% of our production comes from retreating old surface tailings that have been left from effectively 100 years of large-scale mining in South Africa. It's a very good business, as we'll demonstrate. And again, it's in itself, it's a cleanup or a rehabilitation of the environment, because as we reprocess these tailings, we actually free up land for agriculture and for other initiatives and development. And we redeposit these tailings once we've treated them on a central line facility that's compliant with modern protocols and requirements. We have 4,000 people in our group, employees. The number in South Africa, so sort of normally, rule of thumb, 1 employee takes care of 10 dependents. So clearly we have a number of people that are very dependent on our operations. We have ongoing rehabilitation efforts. All of our closure costs or final rehabilitation is fully funded in cash, so there's no risk of a shortfall there. We're subject to a number of independent audits on a very regular basis. So now, in terms of South African legislation, we also required to invest in our communities and local economic development and social programs. We do all of that, and we actually sort of, in our Barberton operation, we even sort of, we're not diversifying, but we sort of creating more jobs on the agriculture space using some of the farmland. So a number of very exciting initiatives, and clearly, you know, we sort of, from our perspective, we make a meaningful, positive difference in all of the areas where we operate. Also, I mentioned the solar side, and we're in the process of developing a 10 megawatt solar project at our Ilekulu operation that we'll refer to a bit later. So that's going to take care of pretty much all of the daytime power requirements for Ilekulu. And I think we'll be the first mining company in South Africa to have this plant up, a similar sort of plant up and going. That'll be commissioned, we forecast, in August of next year. And it'll be the precursor to actually a larger solar effort in the Pan-African group, and in doing so, reducing our cost base even more. So in the previous financial year, FY 2020, was a year of delivery despite COVID. And on slide 14, if we can just spend a bit of time on our operations. So as we operate 2 asset complexes, the first being Barberton Mines, which is the first and second asset that you see on the slide. And then the second complex that we operate is the EVander complex. And we actually have 3 sort of distinct operations also as part of EVander. If we break it down further, both at Barberton and at EVander, we have tailings retreatment, as I've said. So tailings retreatment, effectively, as we said, it retreats old underground mine tailings. It extracts the gold. It does so very profitably, as we will demonstrate, as you can see from these these numbers. And then so we clean up and rehabilitate as we go along. So Barberton Mines, the underground, we produce about 80,000 ounces from the underground. It's a long life operation, still 20 years remaining. The Barberton Tailings Retreatment Plant, we do 20,000 ounces a year, an attractive all-in sustaining cost. And then sort of we looking at initiatives to actually increase the life of that operation. Currently, sort of we're looking at 3 years, but we do have plans in place to further extend that. The Ilekulu Tailings Retreatment Plant, which is part of the EVander complex, we do about 60,000 ounces at a very attractive all-in sustaining cost. So we reported an AISC of just over $600 for FY 2020. Also a very long life of mine, remaining 12 years at the current rate of production. And this Ilekulu project, it was $120 million. We put that money into the ground in 2018 in less than 12 months. And it really is testament that one can construct large-scale projects successfully in South Africa. So initially, we forecast a payback on that investment of $120 million. We forecast a payback of 4 years. At the current gold price, we'll repay Ilekulu in full in this current year. So that's a 3-year payback, which is very good. We also have the 8-shaft pillar project that we'll speak about at EVander. That's going to be sort of 30,000 ounces a year for 3 years. And as the 8-shaft pillar winds down, we will commission our Egoli project, which is a new underground project at EVander. It'll do 70 to 80,000 ounces a year, a long life, probably sort of more than 14 years. The feasibility stated an all-in sustaining cost of sub $800. And the peak funding for this Egoli project is only $60 to $70 million. And that's a product of us using all of the sunk capital that's been put into this asset in the past, and we'll speak about that in some of the later slides. On slide 15, safety performance. We're industry leading from our safety statistics. Certainly, our Elikhulu plant has gone now for more than 12 months without having one single lost time injury or any serious incidents. Barberton Mines also, for the first time in its history, last year achieved 3 million fatality-free shifts. And the fact that, number one, we source half of our production from surface certainly assists on our safety, but then also because we have fewer employees than most of the other larger mining companies in South Africa, we're able to really focus and give individual attention to employees to ensure that our people work safely. Financial performance for the last year, despite COVID, was a great performance. And I'll ask for Dion just to maybe speak a little bit about those numbers and net debt and what we see happening to net debt.
Sure, thank you, Cobus. As is evident from the slide, the 2020 financial year was a substantial improvement on the 2019 financial year. Revenue increasing by 30%. Our senior debt, which is used to finance the Elikhulu plant that Cobus referred to, as well as a revolving facility that we have to fund general capital expenditure, decreased by more than 50% down to 62 million. And I'll touch on the deleveraging of the balance sheet going forward a bit later. EBITDA increased by 50%, and our debt to EBITDA ratio improved substantially. Profits of $44 million relative to the prior year of $38 million. That was at a gold price of $1,574 on average for the 2020 financial year. Clearly, with the gold price where it is now and where it's been for the last 6 months, and where we're hoping to be for the next 6 months, we can expect profits to increase substantially in the 2021 financial year. Dividend increased in dollar terms from 15 cents to 84 cents. That's a 5-fold increase. We do have a dividend policy, which, in terms of which we pay out 40% of discretionary cash flow. In the last financial year, we paid out more. We paid out 62%. To some extent, it was to make up for the pedestrian dividend in the 2019 financial year, but it was also to some extent an indication of our confidence in our operations, their sustainability, and our prospects for the 2021 financial year.
Thanks, Dion. So again, 2020 is well in the past. I mean, suffice to say, we exceeded our revised production guidance. But in terms of the future and looking forward, our guidance for the current financial year is actually also, again, significantly increased to 190,000 ounces, so almost 200,000 ounces, at a guided all-in sustaining cost of approximately $1,000 per ounce. So that was at a slightly stronger US dollar rand exchange rate. So one needs to take that into account. But suffice to say, at this gold price, we still have very significant margins. Also, in terms of our profile, I think it's a point that we've made. Many gold companies sort of be looking 3-4 years into the future, have declining growth profiles. We one of the sort of gold companies that actually have an increasing production profile in the years ahead, with fairly limited capital in order to achieve that growth. So if we spend a bit of time on our sort of just highlights on the assets, slide 17 is our large-scale tailings retreatment project that we have at EVander. The name is Elikhulu, which means the big one in Zulu. We do about 60,000 ounces a year, as we've said, at an all-in sustaining cost of $600 to $700. We're one of the lowest cost producers of gold in Southern Africa. And we're doing more to make this business even more sustainable. As we've said, we busy constructing a 10-megawatt solar plant. And what the other beauty of this plant and operation is actually we have very few employees relative to our production, only about 400 employees. So labor cost is not a major component of our overall cost base. Then on slide 18, the BTRP, which is also a tailings plant. This plant is our Barberton operation, a great also all-in sustaining cost. And this was actually the first gold plant that or tailings retreatment plant we built in the gold space, and it's been a huge success. It's been producing for many years, and it pays for itself. The initial capital outlay is $20 million. It paid for itself in 18 months. So it's been a great project, and it will continue to do so, to perform going forward. And then, slide 19 is the Fairview mine, which is one of the underground operations at Barberton. This is where we get most of our gold. As I said in the introduction, Barberton has been going for 130 years, so it's a nice and long track record. We have 20 years life of mine here, and that's only because that's where we get to drill to. These ore bodies extend significantly further. This just gives you a schematic, but on average, we do a head grade of 10 grams a ton from Barberton underground. We have a lot of flexibility now. We've spent a lot of money on flexibility, and we're seeing that sort of investment now come to fruition. So we have a lot of ground that we can mine on Barberton, and we have exceptionally high grading ore bodies on some of this. So the MRC ore body that you can potentially see on that slide, that grades on average 25 grams per ton, but in the highest grading areas of the ore body, we cut off at 100 grams per ton, so that's exceptional. Also, Consort on slide 20, it's a smaller underground operation at Barberton, but it's been a loss leader for a couple of years, and we've invested in and re-looked at exploration, and we were rewarded earlier this year where we uncovered an area that we expected to grade 25 grams per ton, but some of this grades 40,000 grams per ton, or 4% gold. So this initiative really has turned Consort around. Consort has now gone from being an $1,800 producer, all-in sustaining, to being $1,200 to $1,300 per ounce. And there's every prospect that this will continue. So this block of ground will last us a minimum of 3 years, and we have 6 or 7 additional exploration targets. And then very briefly at EVander, so we have the pillar project. So that's going to give us another 30,000 ounces a year at $1,000 per ounce. So, very, very briefly on slide 22, we have some really nice and quality ounces coming from our low-cost operations, and these are by far the largest chunk of what we produce. And then we have higher cost operations, and we've demonstrated clear efforts to actually bring down the costs of our higher cost operations, principally by mining more gold, and that's what we'll demonstrate in the year ahead. So in terms of the outlook, we're targeting on slide 23, we're targeting a all-in sustaining cost per ounce of circa $1,000. That's for the year ahead, and that's pretty much on par with the rest of the industry globally. On slide 24, it's just clear that we've been reinvesting in our assets. So we through the cycle we didn't save on capital, and our assets therefore are very well capitalized in the current high gold price environment. Dion has spoken about our financials, so I don't think we should spend a lot of time, but suffice to say on slide 27, post December 2020, we'll be unhedged, so we won't have any further hedging in place. Our de-gearing profile in the last year, we really de-geared quite materially, and at the current gold price, we anticipate that we should have the balance sheet completely de-geared in sort of the next 6 to 12 months. So clearly, that also then allows for increased dividends. On slide 29, we resumed quite an attractive dividend in the last year. So shareholders in the last week approved the dividend for this year, which is payable in a week from now. But with the balance sheet de-geared and with our assets capitalized and generating cash, there's every prospect at this gold price of us actually again increasing dividends in the year ahead. And then, I think we can conclude the formal presentation on slide 31, which sort of deals with Egoli. This is our next growth project. I mentioned briefly when we spoke about our assets. Egoli is going to give us another 60 to 70,000 ounces per year. So that'll take Pan African as a group to approximately 250,000 ounces of annual production in the next 3 years. The beauty of this project is that it utilizes all of the sunk capital, and effectively we're developing into a virgin ore body that hasn't been mined, which is quite close to existing shaft infrastructure. So we have the shaft system in place. It's It's actually a twin shaft system extending down a mile, fully operational. We have a operational metallurgical plant and all of the other ancillary infrastructure in place. So it's not rocket science. We understand the geology, we understand these ore bodies. It's quite simply underground development over the next years. The project is fully funded with a debt facility from a consortium of South African banks. So there's no further funding requirement or call on shareholders. And as I've said, I mean, so we continue to look at acquisition opportunities, but we have such a large resource base in our own business and reserve base that we find that developing some of these internal projects currently makes the most sense. So yeah, and just in summary, you know, when you're looking at sort of Pan-African on slide 36, we have a track record of delivery. All of our recent projects have been incredibly successful. As we said, our guidance for the year ahead is 190,000 ounces at an all-in sustaining cost of about $1,000. We'll continue to focus on producing safely, producing sustainably, de-gearing the balance sheet, growing our business via the Egoli project, and then hopefully also increasing dividends and to shareholders in the year ahead. That's a summary. I think we'll open the floor for questions. Thank you.
Thanks, Cobus. A really informative and interesting presentation. So we have one question already from Mark. Whilst Kenneth Spencer has done a good job as chairman, he has now fulfilled his role for 13 years, exceeding corporate governance code recommendation. What is the succession plan?
Yeah, so it's Keith Spencer. So he hasn't been the chairman for the full period. So there was a break. I mean, Keith is now sort of approaching his 70s, so in all likelihood, you know, he'll retire in the next years. And we have a strong board, as we've said, a number of independents with a lot of experience in mining and in South African gold mining. And there are a number of, certainly one or two candidates on the board that would be very much able to take Keith's place. Keith was up for re-election at the AGM of last week, and he was actually re-elected by 90% of shareholders, which I think demonstrates the confidence that shareholders continue to have in Keith as chairman also.
Fantastic. And I'll just remind participants, because I forgot to remind them, if you would like to ask a question, please click on the Q&A tab at the bottom. If you want to type your question. If you don't want to type your question, feel free to click on the participants tab and then raise your hand from there, and I'll allow you to speak to management. So we have another question saying, thank you, Cobus. Great presentation. Is it possible to talk about EVander 8? Clearly 2020 saw high costs as it was just coming out on stream and reliant on surface material. Are things on track now? Are you still confident about AISC circa $1,000 for this asset?
Yeah, so you know, if I look at our portfolio, Barberton is a great producer, so that's 100,000 ounces, and we're doing incredibly well. Elikhulu has been a fantastic success, so that's 60,000 ounces at an all-in sustaining cost of $6,700. The reason why the 8 shaft filler reported such a high cost for the last year was really that we were badly hit by COVID, so we couldn't produce for 4 or 5 months, or sorry, I think 3.5 months to be specific. And then sort of we stopped capitalizing in the middle of May, so our year end is June, so we only had about a month or so. So the 8 shaft filler, we're confident that over its life will produce at circa $1,000. Operationally, we're not quite where we'd like to be yet, if I'm completely honest with the pillar, and that's certainly a focus area for us in the 6 months ahead to get to where we need to be on the pillar. So I think the production guidance is very achievable, 190,000 ounces for the group. You know, the point is made that sort of we make up some of this by surface. Sometimes difficult to sort of allocate costs correctly, but you know, certainly the EVander complex, excluding Elikhulu, is generating cash at this point, And I think there's very good upside on that pillar in the next 3 years. So yeah, we're sticking by our guidance of $1,000 an ounce once that pillar is performing like it should. You know, the mining is relatively uncomplicated. It's right next to the shaft, but as with any operation, it does take a bit of time to get it where it needs to be.
Great, thank you. Another question from Mark, asking, do you have any thoughts about Mogala acquisition?
About, is that the Mintails acquisition potentially?
He
Yeah.
said
Yeah,
Mogala.
Yeah, it's probably Mintails, which is, I mean, we announced effectively an option to acquire another tailings resource by the name of Mintails. It's 2 million ounces sitting on surface. It's in a different part of the Wits Basin. It's on the West Rand, but it's very close to where we're currently sitting. It's about 30 minutes drive. As we've said, we've been very successful in terms of commissioning tailings projects. Our first gold tailings project played itself back in 18 months, the second one 3 years, and the third one, Elikhulu, will play itself back in 3 years. So, you know, we want to build on that success. We have 6 months now to do due diligence, to do a feasibility, and then make a call as to whether we want to proceed with this project. And clearly, you know, with our track record, that's not something we would want to blemish. So we're going to have to be very sure that we can make it work.
Perfect. And somebody else has built on the first question, saying, was the company able to buy? Why was the company able to buy these so cheaply? Were there other operators not competing to buy these assets out of liquidation?
Well, there's been a number of proposals in the past, but if you look at the South African mining space, the majors are very much focused on their own operations, and you know, they're sort of not really reinvesting in an awful many other new projects in South Africa. And the sort of the number of players in the tailings space is fairly limited. It's really ourselves, it's DRD Gold, and it's Harmony that sort of is currently operating these tailings retreatment operations. DRD Gold operate in that area, but they have more than enough tailings resources for their current plant capacity. So these are very large plants. I mean, to give you an idea, to make this feasible, you need to be able to treat about 1 million tons of tailings per month. So, I mean, it's quite interesting. Your head grade runs at a very low 0.3 grams per ton. Your recovered grade is less than half of that. It's 0.14 grams per ton circa. So that means the only way you make this economic is that you treat an awful many tons, so you treat it economies of scale. So we're able to mine via hydro mining and then process a ton of this ore for about $2.50. That's what makes it so attractive. That's why we're able to produce at $6,700. Clearly, that's what we need to make sure we can do on this project before we proceed. But because the majors in South Africa are focused on their own operations, there's not really an intermediate space. And the capital for a plant like this is ballpark, let's say $80 to $100 million. So there's not an awful many people with sort of capacity to raise that level of finance. Clearly, you know, with our market capitalization and our track record, we're one of the few players that actually can do so.
Fantastic, thanks. So we have 2 more questions. Clearly, we've seen a large USDZAR move since the company targeted $1,000 AISC for 2021. How much might this shift up this target?
So yes, I mean, you need to take into account we were running 1650 ZAR to US dollars. So clearly that's going to impact the AIC. Also, what will impact AIC is that, and we sort of made it quite clear that in the first 6 months of this financial year, we have hedging losses, and realized hedging losses by definition are included in the AIC. So, you know, if you normalize that, let's say, you know, we're slightly above where we'd like to be, but we're positive that we'll pull back quite a bit in the second half. And yeah, you know, the year is still sort of has 7 months to go. In our view, our currency is the ZAR is incredibly strong given the fundamentals, and you know, we would expect a bit of a pullback, which will assist us, or which we expect to assist us in the months ahead. But you know, even if that doesn't happen, you know, as we've said, we still have very attractive margins at this rand gold price. Yeah, we'll certainly sort of make sure that the operations deliver.
Fantastic, thank you. And this person's saying, congratulations, Cobus, for succeeding through great difficulties. Regarding Mogala Gold and MSC tailings storage facilities, what is the risk that they have been largely depleted since these sites have been subject to illegal mining for so many years?
Well, the beauty of these resources is the safest place to actually store your gold is in these tailings, because the grade is just quite simply too low for the artisanals or the illegal miners to access. It's not attractive for illegal miners to try and access gold at 0.3 grams per ton. So that's why we process in bulk circa 1 million tons a month, and that's what makes it so attractive. So there's very little risk on the resource. Clearly, we'll check the resource and have it verified as part of our due diligence. But it's the more important bit of that study will be to figure out where do we site a plant, what does the deposition and tailings facility look like, which is obviously in this environment very critical, and sort of what is the social impact in that area in terms of communities and others. But we're comfortable in the resource. There's no way you can steal in any scale at 0.3 grams per ton.
Thank you very much. And another question has just come in saying, developing the tailings dam, Egoli, and the solar, and paying a higher dividend, are these all possible at the same time? What cost of capital are you likely to pay across each of these projects?
Well, we look at cost capital, and Dion will come in there. We also look at payback. So, and I think we've always managed to achieve a balance between dividends. So the first port of call for our capital is reinvesting in our assets to make sure that these operations are sustainable. That's why we've invested throughout the cycle, and we don't have sort of massive makeup capital now to spend. And then, as the balance sheet now de-gears, clearly we'll have more flexibility. The solar plant has a dedicated funding facility, so that's not going to detract from our sort of cash flows. And very briefly, the economics on that solar plant, it's about $8 million of capital, and at a very conservative assumption in terms of utility power increases, that plant pays for itself in 5 years. So that sort of demonstrates the benefit of commissioning these sorts of projects. And then, the Egoli project has its own dedicated debt facility. So again, that's not going to detract from the sort of cash flows available for other initiatives, including dividends. And you look at the feasibility on the Egoli project, sort of pretty much after commissioning, so after year 3, all of the debt is repaid in sort of a space of 12 to 18 months. And then, the tailings project, given our track record, I don't think we're going to have any issue funding that on a basis that's attractive to shareholders, assuming that it stacks up and assuming we sort of, we want to proceed. Just Dion can very briefly touch on our sort of rates of return.
Quite right. Maybe just to add on to that, we look at capital allocation from a cash flow margin per ounce perspective, as opposed to all-in sustaining cost. All-in sustaining cost is a bit of a misnomer in the mining industry. It is abused a bit because it doesn't take into account the capital structure, and it doesn't take into account the tax regime. And as a consequence of that, it is not indicative of a free cash flow per ounce. So just to touch base on Egoli, Egoli has an all-in sustaining cost of approximately $780 an ounce. On top of that, we will require approximately another $220 to redeem the principal on the dedicated facility, principal and financing costs, which will take us to below $1,000 an ounce cash outflow, which gives us at the moment, on the prevailing gold price, approximately $800 an ounce free cash flow margin, which translates back into a 50% plus internal rate of return. And that's typically what we look for in a project. Currently, on our balance sheet, we're giving a 24% return on equity and a cash flow yield per share of approximately 10%. So, these are tough hurdles to consistently grow within the portfolio. And that's why we're selective when it comes to capital allocation, very selective when it comes to M&A. We don't want to erode our value proposition. We'd rather be a relatively small company, but a high quality company, as opposed to a large company, which is mediocre or even worse, very destructive.
Thank you. I guess another question for Cobus. The stock seems very cheap versus history and relative to the opportunities available. What do you think investors are missing? Is this a function of the South African mining investor environment?
Yeah, I think it's a fair point. To some extent, there's a South African discount. And, we question whether, to be honest, again, having operated in other parts of Africa and having come close to acquiring assets as Pan-African in other parts of Africa, I mean, we question whether the South African discount is justified. I think increasingly investors are recognizing that sort of all of Africa, or certainly the bulk of Africa, has issues. Countries that seem stable suddenly are unstable. Coup in Mali, the current situation in Ethiopia, difficult to get cash out of the DRC, terrorism in West Africa, etc. So yes, I mean, I think it comes down to the demonstrated ability to operate successfully. And as we said, Barberton's could be going for 130 years uninterrupted, and sort of proof is in terms of our results and returns. So yes, there's an element of South African discount. Last year, this time, the stock was sort of rated at sort of pretty much half, and people were asking, whether sort of they were getting anything wrong. And so we assured investors that, this is a discount that would unwind, and it has. Clearly, the gold price has helped. But, we have confidence in the story and in our ability to continue to generate the returns. That's why, both Jan and myself are also large shareholders. We recently bought more stock. So yes, I mean, the only way to get closer to what is intrinsic value is by continuing to deliver, and that's what we are attempting to do.
Thank you. We'll just wait and see if any more questions come in. I'll just remind everybody, if they want to ask a question directly, they can enter it in the Q&A box, or you can raise your hand by clicking on the participants panel. So another question here: what are the company's plans concerning exploitation of Sheba?
Well, I think you might be, Sheba is one of the underground mines at Barberton. It's also been going, it's the mine that started in 1886. It still has 10 years plus of life. You will see in this presentation that the costs at Sheba are not sort of where it needs to be. It's an underground mine, so the only way of getting your costs down are by producing more ounces. Realistically, that's what we're going to be targeting in the next 6 months also. So for the year, Sheba will deliver a good performance. If the question then is around Royal Sheba is a lower grade ore body. So again, we spoiled at Barberton. In the past, we haven't mined anything that sort of grades below 10 grams per ton, and we still, as an underground, maintain a head grade of 10 grams per ton plus. So Royal Sheba grades 2 to 3 grams per ton. The only way then to mine that successfully is you need to look at mechanized mining and bulk mining. So certainly the management team at Barberton, in terms of their key performance requirements for the next year, is to come up with a plan to mine Royal Sheba on the upper levels and then slowly get that operation going. So mechanized, very few employees, 30 employees, probably initially targeting 10, 15,000 tons, and then we'll sort of ramp it up from there.
So given the 130 M face available at Barberton now, can the company effectively pick AISC short term, i.e. by selecting the high grade, i.e. a way to smooth financials somewhat?
Look, again, we have more flexibility than what we have, but I mean, that's a fact, and I have to say, as we've said in the presentation, the grades that we're now seeing and that face length at Barberton will assist us. But our thinking is not short term. Barberton mines, in my view, on the underground, is in the best position that I've seen it in the last 5 years. But that doesn't mean that we are going to stop development. Now is not the time to do so. Yes, I mean, if we had to reduce our AISC in a low gold price environment, we could do so because we now have flexibility. But we continue to develop, even though we don't need to be on the next level, the 290, we'll still be there in the next 3-4 months. We want to also create even more flexibility because in the next couple of years, we actually will do a sub-vertical shaft at Barberton to further increase production by probably about another 10,000 ounces. So we're working towards those initiatives, and hence we certainly would have the ability to high grade if we wanted to, but we're not doing so at the moment. And we're unlikely to do so other than in a very depressed gold price environment.
Thank you very much.